Could we be on the brink of another 2008-style global financial crisis? That's what Bank of England Governor Andrew Bailey has warned. And when you look at the events that have unfolded this month, you start to see why. Let's break it down. I've explained before how banks lend to each other every night in the repo market to keep the system functioning, and how the Fed has been sucking liquidity out of that system through quantitative tightening. The Fed's reverse repo facility is an indicator of how much is left in that system. And now it's basically empty. That means there's barely any liquidity left. No cushion if a panic suddenly emerges. Remember this, because it's going to matter in a minute. In early October, we saw the collapse of two firms with heavy ties to the private credit and subprime lending markets. Just the type of panic they didn't need in a system already running on fumes. The very next day, Jerome Powell got on stage and announced that the Fed plans to end its tightening program soon. That's the Fed trying to send a message to reassure markets. They see what's happening and they are ready to act before any further panic. But right after Powell's comments, two big things happened. First, the SOFR rate, the rate at which banks lend to each other in that repo market I mentioned earlier, spiked way above the Fed's target interest rate to levels not seen since the 2019 repo crisis. That tells us banks are nervous. They don't want to lend to each other unless someone pays much higher interest rates because liquidity is tight and trust is fading. Second, the Fed's standing repo facility, the emergency backstop they created in 2019 to prevent a repeat scenario, lit up with activity. This thing is barely ever used. It's been dormant for over a year, but now banks are tapping it daily, drawing on tens of billions at a time. And remember, all of this started right after those private credit failures. Is it a coincidence? Probably not. Now keep all of this in mind, because it leads us straight into the most important development of all. Last week, it got revealed that the Cayman Islands actually holds $1.8 trillion in US Treasuries. 1.4 trillion more than initially thought. But this isn't the Cayman government buying treasuries. It's US hedge funds domiciled in the Cayman Islands running a highly leveraged strategy called the basis trade. They borrow treasuries, often at 50x leverage, short the treasury futures and profit from the difference. It's a fragile trade that only works when funding is cheap and stable. And what underpins that funding? The SOFR rate, the rate that is now spiking. When SOFR jumps, their borrowing costs explode. Those leveraged positions can unwind fast. Oh, and at the same time, another firm tied to the private credit market collapsed. So let's step back and connect the dots. The Fed drained the system through QT. The reverse repo facility is empty. Private credit is cracking. Short-term funding costs are surging. Banks are quietly using the Fed's emergency facilities again. And hedge funds are sitting on trillions of leveraged bets that now depend on low, stable funding costs. The system is stretched to its limits. It cannot survive long without new money being created. That's why owning scarce assets like Bitcoin isn't just a hedge, it is self-preservation. These liquidity shocks are exactly what Bitcoin responds to. And as the Fed is forced to pump liquidity again, you will want to be holding it.